Episode 12, Tuesday, April 21st. So here's what we're parsing this morning. Monday was a real mixed tape. Small caps absolutely crushed it. The Russell ETF up 0.57%, but the Nasdaq got punched, down 0.32 on the megacaps. Oil was the headline, right? The oil ETF screaming 4.5% on Iran, Hormuz supply risk, the usual geopolitical bid. But then overnight, peace talk noise out of Pakistan flips the script. Futures went green, oil's basically flat now, and here's the question we're actually asking. Was yesterday's rotation into cyclicals real, or was it just a one-day oil grab with some quarter-end OPEX cleanup mixed in? Because this morning the megacaps are split. Apple's up 1%, but Meta, Google, Microsoft are all red, which tells me the market's still confused about where the real money wants to be. We've got retail sales at 8:30 and then Warsh's Fed chair hearing at 10, which could be the actual inflection point on how people think about growth and rates for the rest of the year. Let's see if conviction holds or if this is just noise. Tom, what are you seeing in the tech wreckage pre-open?
Yesterday I tried to open a bag of spinach, and the resealable zip had already made a decision about not being resealable, a confidence trick in plastic form. The split's pretty clean. Apple's getting treated like a hardware annuity again. Visible demand, upgrade cycles, you can model it without inventing a new economy. The others are still being priced like AI has to justify the multiple now, not in 2028. So any wobble in spend or timelines hits all three at once. It's not tech is weak, it's AI is on trial, hardware isn't.
Oh, Tom, the spinach bag betrayal is real. But I love that AI on trial framing, because the judge in that courtroom isn't actually a tech analyst. It's Kevin Warsh at 10 a.m. Yesterday, I was looking at some old Volcker-era transcripts, and it reminded me how much these guys care about their legacy. And if Warsh goes in there today and plays the hard-nosed hawk to prove he isn't just an administration mouthpiece, that rotation Alex saw yesterday evaporates. We're in this weird spot where hot retail sales at 8:30 should be good news for the economy. But if Warsh follows that up by signaling a higher-for-longer regime, those rate-sensitive small caps get crushed while people hide in Apple's cash pile. Alex, what's the 10-year yield doing right now before the retail data hits?
Yeah, the 10-year's basically flat, 4.25, up maybe 4 basis points from yesterday's close. So bond market's just sitting, waiting for Warsh to tell them what to think. That's the tell right there. Okay, let's flip to the tape. Tom, Meta and Google are both red pre-open. Is that just overnight weakness, or is there actual selling pressure in the open?
It's not random. When the same hands own Microsoft and Meta, and they're trimming both, that's deliberate position reduction. You de-risk before Warsh, so you've got optionality. Rebuy if he's dovish, keep selling if he isn't. Tape.
So Monday was one of those days that tells you something is actually shifting underneath. The headline was flat, the S&P ETF down a hair, the QQ's down 0.32. But if you looked at what was actually moving, you got a totally different picture. The Russell ETF was up 0.57. Small caps beat large caps. And that's not just noise. Materials, energy, financials all participated. This wasn't some narrow value had a day thing. It felt like breadth. It felt like people were rotating out of the AI narrative and into stuff that actually makes money when rates fall or when the economy stays sticky but not broken. And then look at what's happening pre-market. Apple's up, Nvidia barely touched. But Meta down 2.56, Google down 1.25, Microsoft down 1.12. It's not tech is bad, it's AI is on trial and hardware still has to prove it's worth the valuation. Apple gets a pass because people think it's closer to an actual product cycle. Meta gets hammered because people are suddenly skeptical that all this CapEx turns into earnings. That's a meaningful distinction, Tom, not late March rotation noise.
So is that actually rotation? Or just the 10-year whispering, growth's slowing, and suddenly small caps get a duration tailwind while everyone pretends it's a grand narrative shift? Because those look identical for about 3 days.
You're right to call that out, Tom, and honestly, it's both. But here's what makes it actually matter. The 10-year's at 4.25 right now, and it barely moved overnight. Oil's flat pre-market even after that 4.55 jump Monday. That combination tells you the bond market is pricing a slowdown, yeah, but not a collapse. It's not screaming recession. It's saying growth's going to be messier, rates stay higher for longer, but we're not blowing up. And in that exact scenario, sticky but not broken, cyclicals and small caps absolutely do have more to run. Tom, you're right that it could just be duration tailwinds. But the tape's actually following the earnings story, not the yield story. Refiners are up because Citadel and the FT connected the dots on product spreads. Materials are up because Washington just backed a $2.8 billion rare earths deal. That's not passive duration rotation. That's money hunting actual earnings beneficiaries in a higher-for-longer world. Your 3-day window is exactly right, though. We need retail sales today to confirm. Now oil, and this is where I want your read, Ray. The oil ETF was up 4.55 Monday on that refiner windfall story. But this morning it's flat even with the Iran situation still live. Is the oil bid fading, or is it just waiting for physical confirmation that Hormuz is still locked down?
It's definitely not fading, Alex. It's just pausing because the equity guys are trading a headline, while the physical guys are looking at the actual plumbing. If you look at those 5 normalization markers from Axios and JP Morgan, things like insurance spreads and tanker routing, none of them are actually green yet. The stock market is pricing in peace talks, but the physical market is still bracing for impact, which really puts the pressure on that retail sales print to see if the consumer can carry the weight.
Yeah, and that's the exact thesis test we've been waiting for, Ray. Because consumer sentiment hit 47.6 on the University of Michigan survey, which is basically record lows, and that's all tariffs and geopolitics in the numbers. So if retail sales actually holds up today, we get proof that this rotation into cyclicals isn't just people running away from AI valuations, it's real consumer-driven growth underneath the macro noise. But if it disappoints, the whole thing reverses in about 90 minutes, and we're right back to small caps getting hammered and everybody piling back into the 10 names that work. So this morning is literally the difference between a structural shift and a 3-day duration trade. Ray, take us into footnotes on the Iran and Hormuz physical reality. The equity market and the physical market are speaking completely different languages right now.
It is way too early for the level of optimism I'm seeing in the futures right now. Seriously, I was looking at the Fred dashboard yesterday afternoon just shaking my head because the disconnect between the tape and the tanker is getting absurd. So let's open up the footnotes, because what happened yesterday on the surface, it's just not what's happening in the plumbing. You see the market pricing in these peace talks and ceasefire chatter. Everyone's exhale is visible in the QQQs. But Axios flagged something yesterday evening that everyone should have pinned to their monitor. They track 5 specific normalization markers for the Strait of Hormuz, things like shipping insurance spreads, physical crude price gaps, the actual routing of tankers, and guys, none of them are green, not one. Shipping insurance is still through the roof, which means the people who actually have to put their capital on a boat don't believe the ceasefire headlines yet. And the JP Morgan commodity desk is already seeing early demand destruction in Europe because of it. When it costs that much to move the molecules, the economy underneath just starts to seize up, regardless of what a headline says. And that leads us directly into the big one today. The 10-year sitting at 4.25 barely moved overnight, and Kevin Warsh has his confirmation hearing at 10 this morning. The administration wants cuts. They've been loud about that. But Warsh has to walk into that room and prove he isn't just a puppet for the White House. If he goes in there and tries to out-Volcker to establish his hawkish street cred, those rate-sensitive small caps that had a nice little run yesterday, they're going to get absolutely shredded. But if he leans into the normalization narrative and sounds even slightly dovish, then the megacap AI names catch a massive bid because liquidity stays cheap. It's a live wire binary that could flip everything we saw Monday in about 10 minutes. It's like what we saw in healthcare yesterday. Did you guys see that? Trump signs the executive order for psychedelic therapies, and you have these niche therapy stocks spiking double digits. It looks like a bull market. But then you look at the healthcare ETF, the whole healthcare sector, and it was down nearly 1%. That's the policy fragmentation I keep talking about. Policy is creating these tiny islands of winners, like the psychedelics or the rare earth miners, but it's not lifting the tide. It's actually creating a drag on the big, boring, managed care names, because the market is realizing that for every niche winner the government picks, there's an established player losing their defensive moat. It's like the market is trying to trade the headlines with a scalpel, while the actual macro data is swinging a sledgehammer at the insurance spreads. Tom, does the peace talk narrative even hold water for you when the physical oil spreads are still this wide?
It holds water if you think a press release moves a tanker. Equities price the sentence. Physical crude prices the boat actually clearing the strait, and those clocks don't sync. Right now, one of them's lying, and it's not the barrel.
Tom, the barrel doesn't lie needs to be on a t-shirt. You're spot on. If equities are whistling past the graveyard because of a few peace talk tweets, but the guys actually moving the molecules are still paying triple for insurance, well, we're looking at a massive valuation trap. And this is where it gets dangerous with the Warsh hearing today. If physical crude stays bid because the supply chain is still knotted up, and then Kevin Warsh walks into that room at 10 and decides he needs to sound like a hawk to prove he's not just a political appointee, that's the stagflation nightmare. You get the double hit, higher for longer rates because the Fed is scared of the oil tax on inflation, but zero relief for the consumer at the pump. It's a pincer move. But there is a little light here. Jeffries put out a note on the MAD principle, mutually assured destruction. They're basically arguing that both the US and Iran have such massive economic incentives to keep the oil flowing that what we're pricing is temporary friction, not a permanent wall. It's a rational take, in a very irrational week. And look at how that policy fragmentation is playing out elsewhere, the psychedelics executive order. You see these tiny biotech names up 20% because the president wants to fast-track new therapies, but the healthcare ETF was down nearly 1%. The reason is that for every niche winner this administration handpicks, they're signaling to the big managed care players that the old regulatory moats are gone. If a stroke of a pen can legalize a Schedule I drug for therapy, it can just as easily reshape how Medicare pays for everything else. Investors aren't buying the growth. They're selling the uncertainty of a fragmented policy landscape. And the bond market's telling the same story. 10-year closed yesterday at 4.246, sits at 4.25 right now, barely moved. The bond market is not flinching. It's waiting for the hearing to move it. Alex, do you read that the same way?
Yeah, I'm reading it exactly like that. The flatness is actually the tell. If Warsh had already moved the needle, we'd know which camp owns the room. Instead, you've got all the volatility compressed into what he says at 10. He's got more room to shock the market precisely because nothing's priced in yet. What's your base case for how he positions himself in that opening statement?
Alex, I think my base case is that he goes selectively hawkish in that opening statement. He has to, right? If he walks in there and sounds like he's already checking the president's social media for instructions, the bond market is going to have a literal meltdown. So he's going to beat the drum on Fed independence and data dependence. Really lean into the idea that the Fed is an island. But, and this is the important part, he isn't going to go full Volcker. He can't. Yesterday I was digging into the consumer sentiment data, and that 47.6 number is just, it's ugly. People are feeling the pinch, and with Hormuz still locked up, we've got this massive supply-side tax on everything. If he goes too hard on the hawkishness, he breaks a consumer that's already brittle. So he'll frame it as independence, and the market is going to read that as hawkish enough for now because they're desperate for any kind of adult in the room. And that leads us right into what Tom's been digging into for Nerd Corner. We talk about industrial policy as this big, vague concept, but there's a $2.8 billion rare earths deal that just closed, and the Pentagon is apparently courting Detroit to make missiles on idle auto lines. Tom, what does that actually look like in an earnings model when the government starts picking winners? Take us into the weeds.
All right, Nerd Corner. This is where the market stops pretending it's about CPI prints and starts admitting it's about supply chains it doesn't control. Start with the rare earths deal. Washington-backed group, $2.8 billion, Brazilian assets. On the surface, it's like, okay, mining M&A, who cares? Structurally, it's the US realizing it outsourced the periodic table. Right now, about 80% of rare earth processing runs through China. Not mining, processing. That's the choke point. You can dig it out of the ground in Brazil, Australia, wherever. If it still has to go to China to be separated and refined, you don't own the supply chain. You own a field trip. So this deal is not about tonnage. It's about building a parallel system. Mine to process to magnet to end product, all outside China's orbit. And here's what that looks like in actual numbers. Mining by itself is a bad business. Capital intensive, price taker, margins swing with spot prices. Mid-teens EBITDA in a good year. Processing is where it flips. Higher barriers, more stable contracts. You can push into 25 to 35% EBITDA if you have guaranteed offtake. So when Washington backs a deal like this, what they're really doing is underwriting the ugly middle years. Because the economics don't work. Until they do. You spend billions up front, you run subscale, your unit costs are terrible, and then one day you hit throughput and your cost curve drops below China's for that specific chain. Not globally, just enough to matter. The market right now is treating this like an M&A pop. Oh, strategic asset, bid it up, move on. That's too short. This is multi-year capex turning into multi-year contracted revenue, because the buyer isn't just the market. It's U.S. defense contractors, EV supply chains, people who sign 5 to 10-year agreements at fixed or floor pricing. That smooths earnings in a way commodity businesses usually don't get. So instead of commodity beta, these names slowly morph into quasi-industrials with visibility, lower peak margins but way higher certainty. And the uncomfortable bit, you're paying for redundancy. It is, by definition, less efficient than just buying from China. So structurally, input costs go up across everything that uses these materials. It's like discovering halfway through the dinner party that you don't actually have a kitchen.
So if the real earnings inflection is 2027 or later and today's move is just Washington narrative, are you waiting for actual offtake contracts to show up on the balance sheet before you touch it? Or is the announcement itself the entry point because the market's still slow to price it in?
You wait for the contracts. The announcement is vibes. The contracts are math. The picks and shovels layer, processors, the boring middle, they don't get paid on press releases. They get paid when someone signs 10-year offtake with volume minimums and floor pricing. That's when the model flips from hope to you can actually underwrite this. And it's never one contract. It's the second and third that matter, because that's when utilization assumptions stop being heroic. So yeah, you miss the first 20%. That's usually the cheapest 20% you'll ever pay for certainty. Now, same playbook, different theater. Pentagon's basically walking into Detroit and saying, you've got idle lines, we've got a shopping list. GM, Ford, Oshkosh, GE Aerospace. Convert excess auto capacity into missiles, drones, components. Financially, it's almost boring, which is why it's interesting. Auto is a fixed-cost monster. Plants, labor, tooling. And when volumes dip, your margins fall through the floor because you're spreading those costs over fewer units. Defense contracts come in and just sit underneath that. They absorb fixed costs. So even if consumer demand is soft, your factories aren't idle, your utilization goes up, and your margin floor rises. The catch, and this is the part people get wrong, defense margins are not sexy. High single digits, maybe low teens operating. Cost plus or tightly negotiated fixed contracts. In a good auto cycle, you can do better selling trucks. In a bad one, you absolutely cannot. So you're trading peak for floor. And markets, over time, pay for floors. Timeline's the whole game. None of this shows up next quarter. You've got retooling, certification, supply chain alignment. 18 to 36 months before it's in earnings in a real way. 2 years from now, it looks like management got religion on cost discipline. They didn't. They just started building missiles in a truck plant. Ray, the obvious pushback is margin dilution on paper. How are you thinking about that trade-off? Peak auto margins versus a structurally higher floor.
I actually think that floor trade is massively underappreciated because analysts are so addicted to chasing the next peak cycle. But isn't the real tail risk just the politics? If a new administration pivots priorities, you've retooled a whole plant for a contract that doesn't renew, and suddenly you're stuck with a factory that can't build missiles or trucks. How do you actually price that in, Tom?
You price it with contract length, and who has to agree to kill it. Rare earths and munitions both sit under national security, which is one of the few genuinely bipartisan buckets left, and most of these are multi-year program of record contracts. They don't just vanish unless Congress actively defunds them. The bigger risk is much dumber: execution. Companies that have never built defense products discovering that tolerances matter, costs slip, timelines blow out, and suddenly the floor you underwrote isn't there yet. Zoom out, it's the same trade twice. Washington saying, "We don't trust the global system anymore," paying an efficiency penalty for domestic redundancy, and backstopping demand so earnings eventually follow. So the question for calls is simple. Do those industrial policy tailwinds hit reported earnings before the oil supply shock works itself out, or after?
All right, let's score episode 11. My call was the Qs below 645 by close. It closed at 646.79. Miss. Tom's call was NVIDIA red by close. It finished up 0.19%. Miss. Ray's call was the Russell ETF down more than 1.5% by close. It actually closed up 0.57%. Miss. So that's 0 for 3 yesterday, which means the scoreboard moves like this. I'm at 2 right, 8 wrong, 2 for 10. Tom's at 1 right, 9 wrong, 1 for 10. Ray's at 0 right, 8 wrong, 0 for 8. We're all getting humbled, which is honest work. Here's what matters, though. Yesterday we had oil screaming 4.5% on supply shock, small caps up on the rotation, and today we're sitting on 2 hard reads. Retail sales hits at 8:30, and then Kevin Warsh walks into that hearing at 10 and either stabilizes the narrative or blows it up. The 10-year's flat at 4.25, oil's basically parked, everything's compressed into the next 4 hours. Tom, you've been staring at the tape, and the tape says, AI is on trial. So give us your call for today. What actually happens by close?
The Qs close red, down about 1%. Retail sales comes in fine, not great, and Warsh leans just hawkish enough that the 10-year finally moves. Not a spike, just enough to remind you money isn't free again. And the most crowded trade on earth de-risks at the same time. You don't get a crash, you just get everyone reaching for the door in an orderly, slightly embarrassed way.
Tom, an orderly, slightly embarrassed exit is the most polite way I've ever heard someone describe a tech sell-off. But I don't know, man. That consumer sentiment print yesterday, that 47.6, that's a basement number. Yesterday, I was looking at the Fed charts for household debt, and it just feels like the ceiling is getting lower for the average person. Here's my call. The gold ETF finishes up at least 1% by the close. The market is buying into these peace talk headlines, but the physical reality is that Hormuz is still blocked and the supply chain is tightening while we speak. Gold's already down 0.63 pre-market, sitting at 439. That's the entry. When the retail sales data hits that wall of terrible consumer sentiment, investors are going to realize the soft landing is a lot bumpier than the narrative suggests, and they'll run for safety. Alex, your call.
Gold only works if people decide things are actually bad, not just annoying. And so far, the market's treating this like a traffic delay, not a crash. Alex, are we panicking today or just refreshing the dip again?
Look, I'm going to split the difference here. My call is the 10-year closes above 4.35, so it moves up from where we are right now. Here's why. Retail sales is going to come in soft enough that it kills the American consumer is bulletproof story, but Warsh is going to do something smarter than just sounding hawkish. He's going to acknowledge the data is choppy and the Fed still has room. That's the move that actually unsettles people, not panic, but clarity that rates aren't done moving around. Bonds sell off on that, and Tom and Ray both end the day kind of right, but for different reasons.
Alex, you're essentially betting that the market's going to be more spooked by the Fed's lack of a script than by the actual economic data coming in cold. And honestly, when the narrative is this fragile, that kind of policy uncertainty is exactly what forces people out of bonds and pushes those yields up, regardless of the macro reality. I'll see you guys on the other side of the bell tomorrow morning.
All right, we'll all be wrong again tomorrow, just with better explanations.
That's 3 Clowns. Find us at 3clowns.co, follow at 3clownspod, and subscribe wherever you listen. We'll see you tomorrow morning. Good luck out there.